Welcome back to The Deep Dive, the show where we take critical financial communications, slice them open, and really extract what you need to know. Our focus today is pretty specific, the Q3 2025 earnings Q&A session from Teladoc Health. We're skipping the prepared remarks.
Yeah, and that's absolutely crucial. Look, the prepared remarks, they set the stage, right? Management polishes that narrative. But the Q&A, that's unscripted. That's where investors, the big institutions, really probe. They push on capital allocation. They push on growth drivers. They demand hard evidence that the strategy is actually working. It really reveals priorities, potential fault lines, you name it.
Exactly. It's where the rubber meets the road. So for you listening, our mission today is clear. We're going deep into that Q&A to pull out three core nuggets. First, we need to understand the real mechanics of the 2026 selling season. What's this shift towards value-based contracts all about? Second, BetterHelp. Huge topic. How is that massive, almost existential shift from cash pay to insurance actually scaling? And importantly, why is that pivot so critical right now, given its current profitability? And third, we need to look at the recent M&A catapult, Teladoc. What's the actual practical value they're driving today? How do they fit the bigger picture? Okay, let's unpack this.
All right, so first up, the strategic direction. Management kept talking about 2025 as a, quote, repositioning year.
Repositioning, okay. So it's like more than just marketing spin.
Well, that's the claim. They framed it as fundamentally restructuring their integrated care offerings. It's about driving higher clinical performance, pushing harder on product innovation.
Yeah, they seem quite positive about the innovation part, mentioning new products resonating.
They did. The prime example they leaned on was this new employee assistance program, or EAP offering, called Wellbound.
Wellbound, right. What makes that one stand out?
Well, it's critical because it's supposed to embody this whole integrated care idea in practice. It's not just another siloed product. Management explained it leverages, the combined strengths of their broad primary care setup and the sheer scale of BetterHelp's network.
So connecting the dots internally.
Exactly. Think about the old way. Employee calls an EAP, gets a clunky referral, maybe to some outside mental health network. Wellbound aims to use the Teladoc platform itself to connect that member immediately to the right level of care.
Whether that's coaching, primary care, or straight to a BetterHelp therapist who's in-network.
Precisely. Streamlining billing, admin, and crucially, the user experience. Making those member touchpoints, as they put it, more valuable. They mentioned pilots are already underway for solutions rolling out for the 2026 selling season.
Okay, so the goal is moving beyond just treating sickness when it happens, towards managing the whole health journey using their range of services.
That's the narrative. But innovation is one thing. What about the actual market? How's the environment looking for that 2026 selling season?
Management used the phrase, in line with previous expectations.
Ah, the classic corporate speak for, it's competitive, but we're holding steady.
Pretty much. They did highlight continued solid results in the employer channels. Seems like that side is performing reasonably well across different solutions.
But the pressure point, the real friction, seems to be the health plan sector. That's always the tougher nut to crack, isn't it? Analysts were definitely pushing on this.
Yeah, they acknowledged ongoing challenges there, but they tried to spin it positively, saying the conversations are now much more strategic, focusing on specific problems Teladoc can uniquely solve for the plans.
Okay, but much more strategic. We hear that a lot. Did they offer any concrete evidence that these strategic chats are actually turning into big, sticky contracts? Or is it just talk?
Well, that's the tricky part. The evidence they pointed to wasn't necessarily about the volume of deals yet. It was more about the quality or the nature of the contracting.
Ah, okay. And that leads us straight into this core shift, right? The move towards performance and outcomes.
Yes. This is where it gets really interesting. They're talking about putting skin in the game.
Let's elaborate on that. This value-based contracting idea.
Yeah.
It really sounds like the payers, the plan sponsors, are saying enough with just paying for access.
Right. We're not just subscribing anymore. We want results.
Exactly. Clients, large employers, health plans, they are increasingly requiring Teladoc to guarantee, or at least heavily incentivize, hitting specific performance targets.
So, putting skin in the game. What does that mean in practice? What are they actually betting on? Are we talking specific metrics?
Yeah, they hinted at or directly mentioned hard clinical and financial outcomes. Things like boosting adherence rates for chronic care members or closing specific care gaps the health plan cares about.
Okay. Things like reducing avoidable ER visits.
Yeah.
Cutting hospital readmissions for certain high-risk groups.
Exactly those kinds of things. Teladoc takes on some risk. If they don't hit the targets, maybe their upside is limited. It demands real confidence in their platform and their clinical delivery.
And the flip side, if they do hit those metrics, if they drive real savings for the plan, how does Teladoc uh, participate in that value, as they termed it?
It often looks like a shared savings model or maybe an outcome-based bonus. Say Teladoc demonstrably saves the plan $10 million in claims costs through better care management.
Then Teladoc gets a cut of those savings above their base fee.
Something like that. Now, this kind of contracting isn't entirely new, but management is clearly betting heavily on it becoming a major differentiator. Their argument is, our integrated platform is uniquely built to deliver and measure these outcomes, better than competitors who just offer point solutions.
It sounds like a necessary evolution, but also potentially a more volatile revenue stream compared to pure subscriptions.
Which brings us neatly to the underlying revenue mix in integrated care. We absolutely have to discuss this.
Right. They flagged a continued significant mix shift towards fee-for-service, or FFS revenue, based on utilization.
Yeah, FFS visits are now, they said, well over half of U.S. virtual care revenues. That's a big jump from a few years ago.
Okay, but management called this mix shift a headwind to overall revenue growth. Now, for you listening, that might sound weird. More utilization, more FFS visits. Shouldn't that mean more revenue?
It does seem counterintuitive, doesn't it? But the key factors are predictability and margin profile. Think about the old subscription model, PMPM, per member, per month.
That give them fixed, predictable revenue, often at a high margin, whether the member used the service a lot or not at all.
Exactly. When a client shifts spending away from that guaranteed PMPM base towards an FFS model, that reliable baseline revenue shrinks. Sure, the FFS revenue goes up if people use the service more, but it introduces way more variability month to month. And often, the revenue per member on average might actually be lower under FFS than in a bundled subscription.
So they might be proving value by getting people to use the service, which is good clinically.
But the predictable high-margin subscription base is eroding, which slows down the overall reported revenue growth rate. It's a tricky balance.
Makes sense. Now, what about pricing pressure? Were analysts worried they're just cutting prices on subscriptions?
Management pushed back on that pretty firmly. They said for customers who are renewing those PMPM subscriptions, the pricing trends are generally in line.
Okay, so the takeaway is the revenue challenge isn't mainly about aggressive price cuts on the core stuff. It's more about this structural shift in how clients want to pay, favoring FFS or these outcome-based deals where Teladoc's pay is tied directly to results.
Precisely. They want alignment.
Okay, so we've got the integrated care strategy, the move to value. Now, let's pivot to arguably the most watched, maybe highest stakes part of the Teladoc story right now, BetterHelp.
Absolutely, and specifically this massive internal maneuver, shifting BetterHelp from being mostly a direct-to-consumer cash pay business towards accepting insurance coverage.
A move that feels almost existential, especially when you hear how they describe the legacy U.S. cash pay business. What's the latest temperature check there?
Still deeply challenged. That was the word they used. Management confirmed the competition is just brutal. And it's worsened by, the macro environment, people watching their wallets, more sensitive to out-of-pocket costs for therapy.
And the fact that competitors are offering insurance options, that kind of forces their hand, right?
It totally validates the strategic necessity, in hindsight, of buying Uplift and really prioritizing this payer integration. They almost had no choice if they wanted to compete long-term in the U.S.
And the financials really hammer home that urgency. That BetterHelp segment adjusted EBITDA margin, what was it, 1.6% in Q3? That number just jumps off the page.
It's startlingly low. We really need to pause on that 1.6%. Management explicitly said that figure is almost entirely cash pay.
Meaning all that huge ad spend they poured into BetterHelp to get users in the door. It was generating practically zero profit in Q3.
Exactly. Why so low? Well, they're kind of locked into this high ad spend to keep the top of the funnel full, right? To maintain visibility and traffic. But the conversion rate from traffic to paying cash customer is under pressure due to competition and maybe price sensitivity. And on top of that, they're still carrying the costs of integrating Uplift and building out the whole insurance infrastructure.
So they're running incredibly hot, burning cash on ads just to tread water in the cash market. Makes the insurance pivot absolutely non-negotiable.
Couldn't agree more. It's not a nice to have. It's fundamental to making the segment sustainable.
Okay, so turning to the insurance rollout and scaling, how fast are they actually moving now? post-Uplift acquisition.
The speed is notable, reflecting that urgency we just talked about. They're now live with insurance in 7 states plus DC, and that includes some big recent additions: Florida, Texas, New York, big population centers.
How are they managing that expansion technically? Is it leveraging their existing provider network?
Yes, that seems key. They're building on their large existing therapist network and leveraging their capabilities in credentialing providers with payers relatively quickly. The ambition is really aggressive. They want to be largely national by the end of 2026.
Wow. Okay, so rapid deployment. But what about the early results? Are people actually signing up, using it?
Management said the initial data from the states that have had some time to, quote, season out, where the rollout isn't brand new.
Right, where the trends might be stabilizing a bit.
Exactly. Those states are apparently trending in line with expectations. They mentioned key metrics like conversion rates, getting people from just looking to actually starting therapy, also user growth, and critically, the number of sessions per user.
But they were cautious.
Very cautious. They rightly stressed it's still early days, and the data from those huge new states like New York and Texas really needs more time to mature before they can make reliable long-term forecasts.
And even with this fast rollout, the actual financial impact in 2025 is tiny.
Yeah, pretty negligible in the grand scheme of things. Insurance revenue for the full year 2025 is estimated at only $12 million to $14 million.
Which, compared to the overall size of BetterHelp, is just a drop in the bucket right now.
Absolutely. It highlights just how dominant the cash pay economics still are in the reported numbers, and frankly, how much growth runway they have ahead if this insurance strategy works.
Okay, let's talk about the cost of acquisition, Sanchana dynamic. This is key to the profitability question. BetterHelp already gets huge traffic, right?
Massive traffic. They are a scale player, as management put it. Over 4 million users hitting the top of their funnel each year, driven by that enormous ad spend we mentioned. The problem hasn't been getting eyeballs.
It's been converting those eyeballs into paying customers, especially cash pay customers.
Precisely. In the past, a huge chunk of those 4 million users would hit the cash price point and just bounce. Too expensive. The whole point of the insurance rollout is to dramatically increase the conversion rate of that existing funnel traffic.
So the logic is, if the ad spend stays roughly the same, but way more people convert because insurance is an option,
then the effective cost to acquire each paying customer should drop over time, even if the total ad dollars don't decrease immediately.
it's about getting more bang for their marketing buck, more efficiency.
That's the thesis. Driving a better return on that marketing investment, leading to potential CAC efficiencies down the road. Oh, and they also made an important clarification. BetterHelp isn't going to become only an insurance business.
Right, they expect it will always be a mix, offering both cash pay and insurance side by side.
Yeah, a mixed model to maximize their reach across different consumer needs and preferences.
Okay. And while all this U.S. drama unfolds, we shouldn't forget about BetterHelp international growth. That seemed like a bright spot.
It really did. The non-U.S. business continues to perform well. They reported high single-digit user growth internationally in Q3.
Which helps offset some of the U.S. pressure.
Definitely. And they attributed that growth partly to specific investments they've made in localized launches. They called out France and Germany specifically.
Saying those efforts are now starting to bear fruit.
Right. So that international success provides a bit of diversification and maybe a template for growth outside the hyper-competitive U.S. cash market.
All right, let's shift gears again and look at how those recent acquisitions are actually contributing, starting with Catapult Health. The idea was it would be a big, efficient funnel for the integrated care business, right?
Yeah, and management was pretty clear in the Q&A about how they see Catapult creating value in 3 distinct ways. It's not just one thing.
Okay, break it down for us. What's the first area?
First, just the basics. Catapult continues to perform well as a standalone offering. It has its own clients, its own solid pipeline, as they put it. That's important grounding.
Foundational, sure. What's the second area? This is where the synergy starts.
Exactly, cross-engagement. This is where the integration really matters. So as a member uses Catapult, maybe for a basic health screening or a wellness assessment.
The platform itself is designed to then highlight other relevant Teladoc services, like chronic care or virtual primary care.
Precisely. It acts as an internal referral engine. Management confirmed this capability is fully built, it's live, and, quote, going well. It turns a single interaction into an opportunity to engage the member more deeply across the Teladoc ecosystem.
Okay, that makes sense. But it was a third area that seemed to grab the most attention, especially regarding health plans. using Catapult as a broader engagement capability.
Yes. And this ties directly back to our earlier discussion about value-based contracting improving ROI. Teladoc is pitching Catapult heavily in those strategic conversations with health plans as a tool to reach the unengaged members. The ones who are enrolled in the plan but aren't using any services, aren't seeing doctors regularly.
Those who might be falling through the cracks.
Exactly. And here's the critical insight management shared. They said a not insignificant percentage of people going through the Catapult screening process are being newly diagnosed with conditions.
Like high blood pressure, high blood sugar, things they didn't even know they had.
Right. Which means these people weren't showing up in the health plan's claims data as being sick or needing care. Management described them as
Somewhat ticking time bombs. I remember that phrase.
Yeah. Because they're flying under the radar until, potentially, they have a major, very expensive health event, a heart attack, kidney failure, something serious.
So Catapult, with its screenings, can find these hidden risk members before that happens.
That's the value proposition. Find them early, get them diagnosed, get them into management, whether through Teladoc services or back to their PCP. For a health plan focused on costs, preventing even one major hospitalization can save a huge amount of money.
Potentially enough to pay for the Catapult program for thousands of other members.
That's the implicit ROI argument. While they didn't give a specific number in the Q&A, you can see why this capability is a powerful selling point for health plans worried about future high-cost claimants. It makes the Catapult acquisition look much more strategically vital than just a simple wellness tool.
Okay, very clear. Now, shifting within integrated care, let's look at the core chronic care programs. Enrollment seemed to bounce back a bit in Q3.
It did. They reported 4% sequential growth in chronic care enrollment in Q3. Management said that met their expectations for a rebound after some softness earlier.
And the opportunity is still big there.
Huge. They stress there are still many more millions of recruitables, eligible members within their existing client base, who aren't yet enrolled in programs like diabetes or hypertension management. Plus, they noted that bundling programs together, offering a combined solution for someone with both diabetes and hypertension, for example, is driving more interest and uptake.
Looking forward, what are the 2026 innovations they mentioned for chronic care?
They're focusing on two main things: new connected devices, presumably better sensors, easier data transmission, and enhanced clinical intervention models. And crucially, these new models are specifically targeted at the rising risk and high-risk populations.
So going beyond basic monitoring to more proactive intervention for the members who need it most.
Exactly. The strategy is to use Teladoc's ability to deliver care, virtual visits, coaching, maybe coordinating with specialists to actively intervene and manage these complex conditions. This could mean working alongside an existing PCP or, in some cases, stepping in if the member doesn't really have one.
And the goal, again, comes back to outcomes.
Absolutely. The stated goal is driving better clinical outcomes that translate directly into quantifiable financial ROI for the client. It all ties back to that pressure to prove value and put skin in the game.
Okay, one quick operational point related to the BetterHelp pivot. They're scaling insurance fast, but what about therapist supply? Can they keep up?
Good question. Analysts asked about supply and demand for the BetterHelp insurance offering.
Because if you roll out insurance but people can't find a therapist quickly, the whole thing falls apart.
Precisely. Management stated very clearly that having adequate therapist capacity is a key criteria before they launch insurance in any new state. They framed it as a discipline essential for maintaining user experience and access.
And their current status. Are they keeping up?
They claim they are keeping up with the demand in the states where insurances already live. They pointed to their large existing therapist network and their ability to get them credentialed with payers as enabling this.
Did they give a target for access speed?
They did, a very specific one. The goal is to maintain the ability to match a therapist with a consumer in less than 48 hours, more than 90% of the time.
Okay, that's a clear benchmark.
Yeah.
Keeping that wait time down is critical.
Non-negotiable, really. Slow access is a huge frustration point and a major reason people drop out of seeking mental health care.
And this access, this ability to use insurance, ties into their expectations for the lifetime value, LTV, of a BetterHelp patient, right?
Absolutely. This is a core part of the financial rationale for the insurance pivot. Management believes that having insurance coverage should significantly increase the LTV of a patient compared to cash pay.
Why? Because people stick with therapy longer.
That's the main hypothesis. In the cash pay world, people often make tough choices. They might stop therapy earlier than they should, clinically speaking, just because the cost adds up. They self-ration based on their wallet.
Whereas with insurance, that financial barrier is lower, or at least different.
Right. So the expectation is that patients are more likely to stay engaged in therapy for a longer duration, completing a more clinically appropriate course of treatment. That longer engagement directly translates to a higher LTV.
And that higher LTV, theoretically, is what's needed to eventually offset the potentially lower revenue or margin they might get per individual insurance-covered session compared to a cash session.
Exactly. It's a trade-off. Potentially less margin per visit, but significantly more visits over the lifetime of the patient. That's the economic engine they're banking on.
Okay, last section. Let's zoom out a bit and touch on the broader financial picture, starting with that 2027 convertible note strategy. That's a big chunk of debt coming due.
It is. It's about $1.5 billion maturing in 2027, and it's definitely something investors watch closely. But Teladoc ended Q3 in a pretty strong liquidity position.
Yeah, they highlighted having $726 million in cash and equivalents on the balance sheet gives them some breathing room.
A lot of breathing room and optionality. Management basically said their specific plan for tackling that note, whether they pay down a chunk with cash, refinance all of it, or some combination, will really depend on what happens in 2026.
Meaning how much cash they need for organic investments like building out better health insurance and whether they do any more M&A.
Exactly. They need to see how those needs shake out. They also use this point to kind of subtly reinforce their M&A discipline.
Right. They mentioned the recent deals Uplift for better health insurance, Catapult for integrated care engagement, and also Teladoc in Australia.
Yeah, Teladoc was positioned as supporting their international growth pillar. They framed all these deals as being strategically aligned and financially disciplined.
Implying they're not out there doing massive, potentially risky deals that would drain the cash they might need for that 2027 note.
That seemed to be the message, focusing M&A firepower very specifically on supporting those core growth areas, international, insurance, integrated care, rather than splashy, transformative deals.
So the bottom line on the note is, no definitive action plan announced yet, but they have the cash cushion, they feel they have time, and they're actively planning options.
That's the takeaway. They use the phrase actively planning various options. They'll time the decision based on their internal needs and, importantly, what the interest rate environment looks like closer to the maturity date. They're not going to rush into refinancing in a potentially high-rate market if they don't absolutely have to.
Okay. Now let's talk short-term spending. Management gave some specific guidance on the cadence for Q4 2025 and leading into Q1 2026, particularly around sales and marketing. This tells us where the dollars are flowing right now.
Yeah, and interestingly, there are two quite different stories here, reflecting the different situations in the two main business segments. Let's start with BetterHelp marketing spend.
What's happening there in Q4?
They expect a sequential step down in marketing spend from Q3 to Q4.
Which is normal, right? Advertising gets super expensive during the holidays.
Exactly. It's a typical seasonal pattern. Digital ad costs spike in November and December because of holiday retail competition. So many companies pull back a bit.
But they added a nuance here, didn't they?
Yeah.
The step down might be bigger this year.
That's the key detail. They expect the Q4 step down in BetterHelp marketing spend to be slightly higher than the drop they saw between Q3 and Q4 back in 2024.
Why does that matter?
Because that larger pullback in ad spending is a crucial lever for improving BetterHelp's profitability sequentially. Remember that awful 1.6% margin in Q3. Reducing the cash burn on ads in Q4, especially during the most expensive season, is necessary to help lift that margin figure towards something healthier, which they did forecast.
Got it. So a bigger seasonal cutback in BetterHelp ads to help the bottom line. What about the other side, the core integrated care marketing spend?
Here, it's actually the opposite pattern, though maybe more modest. Management said that because integrated care profitability was strong in Q3, they decided to pull forward a modest amount of marketing spend into Q4 2025.
Pulling spend forward. So spending more now rather than later? What's that aimed at?
It sounds strategically targeted. It's not just blasting general brand awareness ads. They said it's focused on key priorities for setting up 2026 for success. Things like sales enablement tools for their teams, getting ready for specific large client launches happening early next year, refining the messaging around their integrated products like Wellbound.
So investing now to hit the ground running in 2026. But they were careful to say it's not a massive spending spree.
Right. They specifically contrasted it with Q4 of 2024, where there might have been a bigger, more generalized investment spike. This Q4 2025 pull forward in integrated care is described as more modest, more targeted, and more clearly linked to expected ROI, a more disciplined approach heading into the new selling season. Hashtag tag OUTRO.
All right, so let's try to synthesize all that Q&A insight. What does this all really mean for Teladoc and for you, the listener, trying to understand their trajectory?
Well, if you boil it down, you see a company really grappling with a major, complex strategic shift on two critical fronts.
Yeah, the first front seems to be moving the entire integrated care business away from just selling access, the old PMPM fee for just being available, towards actually demonstrating clinical value and ROI.
And critically, participating in that value through those performance contracts. Putting skin in the game, this isn't optional. It feels driven by intense market pressure, especially from health plans.
Right. They have to prove they can save clients money or improve health outcomes in a measurable way.
And the Q&A suggests they believe their integration points using Catapult to find those hidden risk members, linking mental health into the broader picture via Wellbound are the keys to doing that. It's less about just gaining members and more about becoming an indispensable partner that actually lowers the total cost of care.
That's the integrated care story. The other massive piece, of course, is the fundamental overhaul of BetterHelp.
Absolutely. Aggressively managing that pivot away from the challenged low-margin cash pay model that requires just relentless, expensive advertising.
Towards a future where widespread insurance coverage hopefully stabilizes the business, increases patient engagement, and ultimately improves the lifetime value.
And those Q3 financials, particularly that 1.6% BetterHelp margin, just scream urgency. It shows why this pivot has to work. The good news from the Q&A is that the operational rollout seems to be proceeding rapidly and, so far, meeting internal expectations, though it's early.
Which brings us to the final provocative thought we want to leave you with, something to keep chewing on as you watch Teladoc going forward.
Right now, the BetterHelp segment's reported financials are still overwhelmingly dominated by those legacy, cash pay economics, high ad spend, low conversion, minimal profit. Management's entire thesis rests on the belief that the insurance pivot will lead to much better session continuity, patients staying in therapy longer, and therefore a significantly higher lifetime value, or LTV, per patient.
So the big question is, if that LTV thesis proves correct, if patients do stick around longer under insurance, will that higher lifetime value ultimately generate more profit over time than the old model, even if the margin Teladoc makes on each individual insurance-covered session is lower than a CAF pay session?
Or conversely, will the added complexity and potential reimbursement pressure from dealing with hundreds of different insurance payers further squeeze margins, negating the benefit of longer engagement? That fundamental tension, the hoped-for higher LTV versus the potentially lower margin per session, that's the core economic battleground for BetterHelp.
And how that plays out as they scale nationally through 2026. Well, that will likely determine the long-term success and profitability profile of Teladoc's entire mental health strategy. Definitely something to keep a close eye on.